You're listening to the Wealth Mindset Show, where Hixson Zerker Capital Management's team of finance professionals, portfolio managers, and a life coach come together to tackle complex topics in finance and retirement planning so you don't have to. From investment strategies and wealth management to tax planning, retirement income, and aligning your money with your values and purpose, the Wealth Mindset Show offers the tools to thrive.
All right. Hey. Welcome back to the Wealth Mindset Show, where the Hixson Zerker team helps you manage wealth, navigate retirement, and make smart decisions for a secure, meaningful future. I'm Austin Wilson, Director of Investments at Hixson Zerker Capital Management.
And I'm Josh Robb, Director of Wealth Management at Hixson Zerker Capital Management. And Chase Rose is joining us today, talking about one of his favorite topics, which is bucket investing, or how you group or visualize your different goals and targets.
See, this was confusing. Buckets. When I started learning about this, because, I had to learn about this, I said, bucket investing. Every bucket I've bought, I've never made a dime on.
Yeah.
So I can see a dad joke coming from a mile away.
It's a good one. It's a good one. But yeah, that's kind of what we're talking about today. But first, what's going on, Chase?
I've
You're
got
relaxing.
Nothing.
The ice cream shop is closed.
It is. It was closed
Katie's
last
home.
week too.
Yeah, Katie's home. Everything's good.
Katie is home. She's happy. She's healthy. That's all. Yeah. All I can ask
Little
for.
doggo time.
The doggos are also happy and healthy. They're not locked up in their cage all day. So
now, do you have? Our neighborhood is on high alert. There's a skunk wandering our neighborhood. Been caught on Ring cameras. So everybody's like, watch your dogs, because the last thing you want is for your dog to get sprayed with a skunk.
Yeah,
and you have to deal with
I have actually experienced that when I was younger. I was in high school, played football. I came home from a Friday night game, and I got home. Dog ran outside, went potty, ran back inside. Skunk.
No, terrible.
Skunk. Terrible. We had to,
Great.
I smelled like skunk for weeks.
And
I felt bad for everyone who had to be around me. So that's like almost PTSD at this point.
And
there are
day.
skunks. There are skunks.
They're around.
I was on our front porch, I don't know, bringing the flag in one night or something. It was dark. And I saw a skunk across the street right by Jordan's house, actually. So Jordan lives across the street from me. And it was a skunk, a mama skunk, and like 10 babies. The skunk ran across the street. But like the babies were like swarming around her. It was crazy. And they just scurried off in between our houses. And my dog was
like,
inside.
if you don't mess with them, they're fine. The problem is the dogs don't know. Like, he's not going to walk up and spray you, right? Yeah. People don't get sprayed by skunks unless they're messing with the skunk. The skunk's not looking to do that. But the dogs don't know any better. They see an animal, they go after it, and then they get sprayed.
I've heard they make great pets, and you can remove their stink.
You can remove
that. Sounds too much for me.
I wouldn't risk trying to get those things out in the first place. You're probably going to suffer.
I know. So I think you may need a bucket if your dog gets sprayed by a skunk. We're going to bring that back full circle.
Back to where we were.
To talk about bucket investing, and it's an interesting way to think about life when you're talking about your money. Goals for money. But different money has different goals. You can't just look at all your money in one picture and say, oh, this one pile of money. It has to do everything.
So like when we've talked about the past is like creating a net worth statement.
Well, yeah.
You really summarize it up into assets minus liabilities, net worth. So there are some ways where you do look at it as one big bucket.
Yep.
And you use it some kind of a targeting. How is it growing? Am I on track? But you're right in that once you get nuanced, not everything has the same goal.
Yeah, so maybe you've got a roof coming up.
Yep.
That might be in a couple years. That obviously should be handled very differently than retirement savings or something in the middle. Maybe you need a new car or kids' college or these different time often dictates the needs for money, right? Mm-hmm. Short term, medium term, and long term. And there's a couple ways to look at this, like that you could do really wrong. You could say, well, if it's all looked at the same thing, if I sit it in cash, well, I'm missing out on growth.
Yeah.
Mm-hmm.
But if I put it all in equity markets, I could really have a lot of volatility and have potential for losses. And if I need it, I have to sell at a loss, and no one wants to do that. And the blend of all of this is really where it comes to fruition when we're talking about the bucket investing approach. So kind of briefly, Chase, just talk a little bit about the bucket investing, the bucket approach.
Yeah. So I see this there's really two different ways that you can use the bucket investing approach. One is if you're retired and you have this nest egg of savings and investments that you've built up over your life that you're now tapping into to cover your lifestyle expenses, the bucket approach, we kind of split your short-term, your mid-term, and your long-term goals into different buckets, right? And the reason we do that is because the expenses that you're going to need to cover over the next couple of years, you'll need to tap into that. And if you're, if you have everything in one bucket, maybe you're selling everything incrementally and we go into a bear market, then you're selling stocks at a loss.
Mm-hmm.
Yep.
Or if we're in a bull market and you're living off of cash, you're missing an opportunity to sell stocks while they're at peaks.
Right.
So we like to split different buckets into different accounts. We do it by account. Oftentimes you can even go as basic as just saying, here's this allocation in your portfolio that we're marking for this. This is for this and this is for that. However, while you're working, if you're not a retiree, you can say, hey, I have a roof repair that I know I'm going to need to pay for in 4 years, right? And we can split off a different account, and this is how we do it typically. We'll split off a different account that we know is earmarked for that specific goal. It can be anything. I'm just using a roof expense as an example. And we're going to invest that account based on the time frame and the amount that you need to cover that expense.
Yep. And along with that, and we'll talk about this as each bucket, but the type of accounts dictate too which ones we're going to highlight or earmark for those short-term, midterm, or long-term growth.
Yep. And I tend to think about this as, so if you're looking at a sinking fund is the idea, especially for those shorter term needs. So let's start with short term, right? Maybe 1, 2, 3, 4 years out, pretty reasonably close to where we are right now. I use the sinking fund philosophy, and this is kind of the way I view the bucketing thing, where I say, I know in a year, I'm going to be needing to buy I don't know. Usually it's like freezer meat.
Mm-hmm.
So I know how much freezer meat's roughly going to be in a year. So I know that 1/12 of that every paycheck goes right into that account.
Absolutely.
And then it just comes out. And it's in a money market fund, right? So it's very conservative. It's pretty much like cash, but it earns some interest. Safety, liquidity, very, very high there. Another thing, if you want to do a roof in 4 years, you know that roof's going to be $40,000. Divide that over 12. Every month, 1/12 of that goes into that account. That's kind of a great way to do that. Things you don't want any volatility to touch, right? That's kind of the key there. Safety, liquidity, you could access it very quickly if you had to. Where could you put this? What are some account types?
Mm-hmm. Yep. So ideally, it should be an after-tax. I wouldn't even say you should have this, like your Roth IRA should be aggressive, right? So a Roth is a version of an after-tax, but it's a tax-free account. We're talking a normal after-tax brokerage investment account.
You can do anything with it.
A bank account, a savings account. You need a place where you can hold cash and tap into that cash at a moment's notice. And what you should be investing into, ideally, especially if rates are low, you should be investing in money market funds or have money in a high yield savings account. That would almost always be my recommendation. 100%. If rates are high and you want to optimize more, you could theoretically do some type of CD ladder or a treasury bill ladder. But then you're kind of losing out on the liquidity aspect of it, right? If you surrender a CD before it matures, then you lose X amount of interest.
And that comes to, what is that short-term goal? Is it something that will happen within this time frame or at? So for instance, if you have a kid going to college in 3 years, that's not something that's going to surprise you along the way. You could use a CD ladder or something that has a maturity date because there's a set time to it.
Mm-hmm.
But if it's I'm going to need a new car in the next 3 years.
And then a year from now, your car breaks down.
Right.
Think about it that way, is when we're talking short-term goals, there's different goal types.
Correct.
So you may say, hey, a CD ladder works for this goal, but not this goal. Because one has a set time, I know it's going to be activated, where another one could happen at some point, down payment on a house. Well, I don't know when I'm going to find the house I want, so I want that liquid.
Yeah.
And another thought, the reason that volatility is something you don't want in this bucket at all, like keep it cash-ish or cash plus yield, right? So money market fund would be what I would call that, is you don't want to have to sell that investment when it's down. So that's why you are pretty much taking zero risk here and just buying things that are going to generate a little interest, but no price movement essentially, and be good to go.
Yeah. The question to ask is, what's my time frame? That's that short-term goal. But then how flexible am I with that time frame?
Mm-hmm.
So if you have some flexibility, you could get a little more aggressive.
Right.
If you say, for instance, I'm going to want to get a car, but it's not essential, I could stretch this out, right? So maybe it's that fun thing you're going to be doing, right? That's short-term need, could be a little more aggressive on the scale of things because you said it's not an imperative thing.
Right.
I could stretch that. I'm saving up for this big trip. Do I have to take it in 3 years? No. I could be a little aggressive to try to get more money if I'm willing to extend the timeline. So those are the questions you have to ask yourself when you're thinking of what should I hold and where should it be held? Because how often will I have to need it? And will or can I be flexible?
Mhm.
So let's take a step further
Yep.
in our duration of money needs.
Actually, before we do that, I did have a couple facts that I wanted to share.
Factoids.
And this is also primarily dealing with retirees, but also can apply to if you're saving for certain goals as a non-retiree. Another reason we kind of have a time frame, right? We're looking at 1 to 4 years. And the reason that we do that is if you look at the last 50 to 60 years in the stock market, the average duration of a bear market and how we look at this is from the peak, all-time highs, to the bottom, and then recover back to where you were before. The average duration is 32 months. So if you have stock investments that you need within the next 4 years, and we go into a bear market fund, or we go into a bear market right now, there's a chance that on average, 32 months from now, you will not have grown your assets at all, or it could even be lower than where it's at.
Yep.
And I prefer a 2-year time frame. Anything within the next 2 years, you should not be investing at all. Just do some type of cash or money market fund, because the median bear market is 24 months from peak to trough to peak. So that's why we're kind of looking at a 1 to 4 year time frame. And that itself is also based on the investor's risk tolerance. So if you're a conservative person by nature, maybe 4 years is more appropriate. If you're aggressive, maybe 1 to 2 years would be a little more acceptable.
And that's why in our world, when we're meeting with clients, a lot of things that we're recommending is getting that cash built up on the sidelines out of the market.
Absolutely.
And that's in something we call it a bear market fund, is what you're alluding to here.
Yeah, exactly.
2, 3, 4, whatever you're comfortable with, risk tolerance wise, living expenses covered in something that's very not risky. Now, we've invested it usually in such a way that it can generate a really good amount of income and yield, but it's not super risky. And it's fixed income. It's usually shorter term fixed income. So that is the bear market fund concept. So you don't have to sell your equities like we already talked about when they're down, right?
Correct.
We're going to take a quick pause in this episode. Before we get back to today's topic, I want to take a quick moment to share something that could really help you on your retirement journey. At Hixson Zuercher Capital Management, we are all about making sure your financial life aligns with what truly matters to you. That's why we created the assessment, Are You Retirement Ready?, over at hzcapital.com/quiz. It's a quick and easy quiz that helps you figure out how prepared you are for retirement. It only takes a few minutes, and you might discover some great insights into what you need to do before you retire, both in the financial and non-financial aspects. So if you're curious about how ready you are to embrace this new phase, head on over to the website and check it out. Again, that's hzcapital.com/quiz. Now let's jump back into our conversation. So now we'll take that step out. You did 1 to 4. You got your short-term needs covered. I'm saving for those. I understand what's coming, or I'm flexible and can make that work. Middle term, talking midterm needs, bucket 2, 4, 10 years, somewhere in there. How would you guys invest that?
Yeah. So Josh, you made a comment earlier. When someone has a goal in mind, but not a specific preference on when they're not, I guess, I don't have to reach it by this date, right? I can be flexible and reach it sooner if the markets do well, or later if the markets don't cooperate as well. And so that's kind of what I would throw into this midterm bucket, right? If you have, for example, someone who is happy in the house that they're in now, but ideally someday they want to upgrade, right? So you kind of start saving for a down payment on that house. If the market does well, and your stocks, kind of pull their weight, you can buy a house in 4 years. Or if they don't cooperate, maybe it's more like 6 to 7 years. So this is kind of the things that fill that bucket, is more so like if you're flexible on when this goal can be reached, then let's kind of look more to a little higher stock exposure.
The goal doesn't have a hard deadline.
Correct.
You can be more flexible.
Correct.
I do know a client, one of the things that comes to mind for me is they had this like dream family vacation. There was no year that they necessarily needed to take it on, but they just said, here's something like we've always talked about doing, I want to do. And they didn't want to wait till everybody was in their 60s, but they said, hey, it's pretty open. I just know I need X amount of dollars. That's a great goal for this kind of midterm. It's like, it's out there, but it's market helps. We could go sooner. Market drags along, it could be a little longer. As long as they're tolerant and they're open to it, you could try to get there quicker by investing kind of a little more moderate in your investments.
Yeah.
The other thing is just farther down the road. So, let's say you have a 10-year-old kid and you know you want to save for their college, well, that college we know is 8 years away. It's not coming any sooner, probably, unless they're super smart or whatever, but you probably figure that out. But 8 years. Okay, I know the time frame. I could be a little more aggressive, at least the first half of this goal, and then it moves into that short-term bucket list. So it also may move from one bucket to another as that time frame changes.
And I would say when you're looking at investments for this sort of way of thinking, again, this is a very wide time frame we're talking about here, but this is where you move out of the cash and money market side of things to you start, if it's still on the shorter end of that, you maybe look at like short-term bonds. You can increase your bond duration the longer that gets, but you also might start thinking about adding in some equity exposure. And by the time you're looking out 10 years or so, you might be looking at something like a balanced portfolio, which is what we're thinking of as like a 60-40 or a 40-50% equity, 40-50-60%, somewhere in there, but still a little bit less risky. We would be advocating for something like, hey, maybe some dividend stocks, maybe something that's producing a little income with less volatility, less downside.
Now, you should always be diversified just for the sake of risk return metrics, but even more so when you're talking about the shorter time frame, right? Because if we have, let's say, for example, if the U.S. stock market goes into a bear market, international stocks might still be doing well.
Gotta have it.
Right? So you're spreading your exposure not only across dividend versus non-dividend, but also just in the U.S. compared to other parts of the world. And another thing I would want to discuss here, I talked about bear market statistics. I keep saying bear market fund. It's a term that
I know you use it all the time.
I use it all the time.
Yeah.
When we looked at the last 50 to 60 years, the longest bear market that we're looking at lasted 7.5 years. So personally, this is how I see it. When we're looking at a time frame between 4 to 7 years, I prefer to lean away from stocks, too much stocks at least. But if we get longer than 7.5, 8 years, more towards that 10-year time frame, that's when you can have equities, because equities are the asset class that have proven over time to get the return that you want. So then another, to allude on a topic from earlier, talking about retiree spending. So you're certainly going to spend money every year. Everyone does, right? And we're filling up years 1 through 4. This is what you need over the next 4 years. We'll keep it in cash, conservative. The next 4 to 10 years, that's what we consider to be this bucket. And again, you mentioned earlier, we look at more of a balanced fund, so a 60-40 stock to bond ratio. And that's kind of how we would look to do this portion of a retiree's portfolio, depending on the risk tolerance, obviously.
Of course. And so you mentioned stocks being the best growth engine, historically speaking. That's what brings us to that long-term bucket.
Long-term bucket,
so
bucket
we're
3.
looking over 10 years, that's where equities show up more.
Absolutely.
And that's because they are the best growth piece, but they also have the most volatility.
Absolutely.
And so you got to allow them that volatility to capture the long-term growth. And so when you have 10 plus years, that gives you the opportunity to stomach those ups and downs at whatever risk tolerance you have. That's where you're going to put most of your equities.
It's worth the volatility because it is proven to be the only asset class to outpace consistently inflation.
Yes.
So those 1 to 4 especially, but even getting closer to 10 years, you're not as concerned with inflation. Inflation over that relatively short of a time frame, it'll be there, but it's not going to like ruin your life, right? And hopefully the interest you're getting is offsetting some of that, but you're not worried about grow.
Exactly.
But if you're looking out 10 years, inflation compounds out more than 10 years, and it is where you need to have equities. They've just proven to be the only asset class that can really outpace over the long term. So that's where you're looking at long-term growth here. This is where we would say, equities are your friend. That could be individual stocks. We have individual stock portfolios here that we manage. Equity ETFs or mutual funds. Hopefully, like Chase said, globally diversified is a key metric for your overall portfolio because, it can be international, emerging market, large cap, small cap, mid cap. There's so many buckets, but you really need exposure to all of them to be diversified, right?
And understanding that with that bucket, we're talking long term, 10 plus years out. When you're a retiree and you have to get over the psychological hurdles that a bear market can bring, it's very refreshing. It's very calming to know that the majority of your stock exposure is earmarked for those, spending years 10 plus years out. So if we go into a bear market and the market's down from 20 to 30% from all-time high,
I'm not touching it.
It is so nice. It's not fun. It's not.
but it's not going to wreck your plan.
Correct. Because psychologically, I don't need these dollars for another 10 years, right? And that can be really freeing for someone in that situation.
Yep.
So.
And then along with that bucket, kind of the last thought of that long-term piece, you may have retired. So, well, I'm retired now. I'm done.
Mm-hmm.
Well, how long are you expecting to be in retirement?
Right. Exactly.
And then the second, remember, we're talking about goals. Do you have a legacy goal? Because that time frame for those assets may actually be beyond your life.
Correct.
Mm-hmm.
And so even if you're 80, 90 years old, you may say, I may not have 10 plus years. Why would I be invested? Well, what are you hoping to have this money do beyond you?
Correct.
Mm-hmm.
Should it be growing for that next goal, that legacy piece you're doing? So even when we talk about this, remember, we're talking goals, the length of those goals, not life expectancy or things like that. We're talking about what are those dollars really designed for in your ideal scenario? What's that time frame?
Yep.
Mm-hmm.
And that's what we're targeting.
I was talking with a client not too long ago, and they came into their meeting with us, and they made the comment. They said, based on my age, Google or whatever article they found online, I should be X amount of stocks, X percentage of bonds in my portfolio because I'm 75. Let's just use that for an example. And that is the thing that annoys me most with this whole discussion around stocks to bonds. How aggressive should you be? How conservative should you be? First off, you got to understand the client's risk tolerance. This person specifically is a very high risk tolerance. We know that just through a very long relationship with them. Yeah. But also, their annual withdrawal rate is 1% of their portfolio. Yeah. Okay. And so think about 10 years of withdrawals. 10% of your portfolio. If you had 10% of your portfolio outside of the stock market, you had 10 years of living expenses covered.
Right.
Not that would be a 90-10 stock to bond ratio. I would say that is a prudent investment for this client, right. But they think that they should be 60-40 because of all of these, based on your age, all this stuff.
The rule of thumb is probably what they're talking about is you take 100 minus your age, and that's how much equity exposure you have. So if they're 75, they're looking at that and saying, I need 25% equity exposure.
Or for a 30-year-old, 70%. No, you need to be 100% equity.
Correct.
Probably. I'm just caveating.
If you're saving for retirement,
it's 100%.
You should not. Yeah.
I know.
And so that's the one thing that we talk through with our clients is there's these rule of thumbs out there. And they're there for a reason, because for somebody who doesn't know what to do on their own,
they don't know what to do.
The worst case too is you're too aggressive and it scares you out of staying invested long term.
Right, correct.
But when you're mindful and taking a practical approach of looking through goals and reasons, more often than not, those things are way too conservative for what you're actually trying to do.
Yeah, absolutely.
And what actually ends up happening is the older you get and the further you get into your 70s, 80s, and 90s, you probably actually have more risk tolerance than you think you do.
That's years of experience.
Right?
Yeah.
So
that, and you also say, I'm not running out of money.
I'm not running out of money. I know what the markets are going to do.
Exactly.
So exactly. Yeah. So let's just put some practical, takeaways at this whole bucket investing process. So let's just kind of recap. Short, mid, and long term, right? Those are the three buckets we talked about. 1 to 4 years, really conservative. Just pretty much trying to get some interest.
Yep.
4 to 10 years, kind of that middle term thing. We can start edging out on duration, maybe on some bonds, but also maybe a little bit of equity exposure, right? Keep it conservative.
Grow second.
Keep it conservative. And then, boom, long term, 10 plus. We're willing to take on some risk. We are willing to absorb some volatility as well, because we know this is a Nick Murrayism, by the way. Time kills volatility.
Yep.
And that's a lot of time, right? It is unlikely to have a bear market last 10 years. Not impossible, but unlikely. So therefore, that's your growth engine. Keep that growing for your overall, long-term plan there. But the questions you have to ask yourself is, hey, do I have too much cash? Am I too conservative where I'm giving up growth? Or am I too risky that I don't have enough cash to meet my short and midterm needs, right? And that isn't a question that only you can answer.
Yeah, correct.
It goes to each person's individual plan, individual goals, individual risk tolerances, and that's where I think it really comes down to having a professional. Yeah. So talk a little bit about just why this is a great time to talk to an advisor.
Yeah. Go ahead.
I was just going to say, you can get so focused in on things or have a bias that having someone else talk through it with you helps bring that to light. You may be sitting there saying, no, I need this much cash. And you have a professional kind of walk through, well, what would you do with it? Why is it there? And kind of walk through and see what am I actually protecting against?
Yeah.
And you may realize that my thought of what I need is different than what I actually really do need.
Yeah.
And then the advisor's job too is to make sure along the way that as time goes on, those things all stay in the right balance. Because if you got a retiree who's living consistently with withdrawals, that's going to deplete it. When do I refill it? Where do I refill it from? Having somebody help think through that and being strategic really helps optimize it.
And ideally, what you should do, first and foremost, we've said this a million times, you have to create a plan, right?
Yep.
And when you're creating a plan, you should take the recency bias out of consideration. What's the market done over the last month? Who cares? It doesn't matter. What we're focusing on over 30, 50 plus years, what has the market reliantly gotten you in these certain investments? And then you should build your plan based off of that. At least annually, I would say annually is a good frequency. You should rebalance the portfolio to refill the cash from whatever has performed the best over the last year. If we're in a down market, you're probably going to sell some bonds to fund your living expenses for the next year. If we're in a bull market, the stocks are doing well, great opportunity to sell at a gain, at peak market levels, fill your cash up, and then you're in balance for the next year. However, do not make a change to the plan based on recency bias. You should only make a change if your goals are changing.
Correct.
If you have a desire to spend
goal or
more,
life situation change.
correct. If you have a desire to spend more or less, that should be discussed. If you have a desire to do something for the next generation, that should be discussed. But if you're scared about markets, you should not make a change.
Probably
based
the
on
worst
that.
time you can do it.
Correct. Absolutely.
Because you're only going to be scared when something's going on, and that's probably already past the time where you should have made a change.
Yes, exactly.
So that's bucket investing, Chase's favorite topic in the entire world.
Yeah,
So
let
thanks,
me
Chase.
cook. I was ready to go today.
The bucket investing, it pales to other things.
Pales
Yeah.
to other
There you
things.
go.
Absolutely. The dad joke made it in. So your homework, we don't often give homework to our listeners, but this week, you got some homework. So take a few minutes, look at your situation, think about your short, your mid, your long-term goals, your needs. Is your money really where it should be? Just evaluate that. And this is a great, chance to talk to your advisor and make sure that you're on track to have all those goals funded.
Yeah. And when you have those buckets separated, this is another thing that we prefer at our firm at Hixson Zuercher is when you have the buckets separated, you know how each portion is playing its role in your portfolio. You know how your cash is doing, you know how your bonds are doing, you know how your stocks are doing in all those different areas. So pay attention. If you have everything lumped into one account, it might be hard to decipher what's doing what and how are these different accounts doing. But yeah, that's just our perspective on it.
So that's bucket investing. If you found, value in what we are saying, first of all, check out our website at thewealthmindsetshow.com. We have our show notes and all the links and everything you can talk about and think about there. So check that out. Also, don't forget to hit the subscribe on your player or the subscribe button on your player, wherever you're listening to us, so you get new episodes when they drop. Follow us on social media because we're pretty active on there and we'd love to stay in touch. And always feel free to check out hzcapital.com, which is where Hixson Zuercher Capital Management is hosted. And we would love for you to check us out on the web. And thanks for listening, and we'll see you next week.
Talk to you later.
See ya.
Thank you for joining us at the Wealth Mindset Show, where we tackle the complexities of finance and life planning to help you align your wealth with your values. We hope today's conversation provided value and clarity as you navigate your financial journey. Your hosts work for Hixson Zuercher Capital Management, and all opinions expressed by them or any podcast guest are solely their own and do not reflect the opinions of Hixson Zuercher Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hixson Zuercher Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment, and any investor attempting to mimic index performance would incur fees and expenses that could reduce returns. Securities investing involves risks, including the potential loss of principal, and there is no assurance that any investment plan or strategy will be successful.